Welcome to Lesson 7. Next week will be our last, and congratulations on doing a great job so far. Today we discuss Chapter 11, Proprietorships, Partnerships, and Corporations, the three different forms of business organization. We begin with a description of each. Our main focus will be on the corporation, of course. Although they are not the largest employers, they are the sort of the umbrella under which all smaller businesses tend to operate. Key to the formation of a corporation, of course, are the articles of incorporation and the corporate charter. This charter can be obtained from either from the states, and there are also federal charter corporations. Each of these is a public document that's issued to establish the legal existence of the corporation. Only a few laws regulate the operation of proprietorships and partnerships. Corporations, however, are very heavily regulated. Ownership of a corporation is evidenced by stock certificates called shares. A closely held corporation is one for which the stock trading is done between individuals only. A publicly held corporation has its shares for sale to the general public through brokers who are members of an exchange like the New York Exchange or the American Stock Exchange or the over-the-counter, otherwise known as the OTC exchange. Extensive regulation of stocks began after the stock market crash of 1929 during the subsequent Great Depression. More recently, following the dot-com crash at the turn of the century, brought on other further regulations in the form of the Sarbanes-Oxley Act of 2001. One drawback to corporate business is the double taxation of income. Corporate income is taxed when earned, and then the dividends from this income are taxed from the individual stockholders when they are paid out. The Chapter S corporation was invented to ease this situation for the owner by taxing at the individual rate and one time only. Key advantages of corporate business are limited liability, meaning you can only lose what you have invested in the company, not personal assets, continuity beyond the life of the owner, ease of transfer of ownership, advanced management structure, and the ability to raise relatively large amounts of capital. We now introduce accounting for capital stock. Concepts include par value, stated value, and other valuation terminology. Stock is categorized as authorized stock, issued, outstanding, and treasury. Classes of stock include common and preferred. Included are procedures for recording dividends, stock splits, and appropriations of retained earnings. The price-earnings ratio is covered along with the price increases and decreases, and the chapter closes with control of the business through majority stock ownership. The 10K financial statements are briefly mentioned as well. In class, we will examine financial statements of some selected firms and discuss the various sections of the 10K report and how it aids investors wishing to purchase a stock that is likely to be a sound investment. For the last week, we will examine statement of cash flows and the importance of these statements to running a business. If time permits, we may discuss investing in stocks as a wealth-building activity. Be sure to review your grade status by completing any unfinished assignments and/or quizzes, and if we have any adjustments that I have not yet made, please bring them to my attention. And looking forward to seeing you in class Wednesday night, and we will have us a grand old time. Thank you.